Looking at depreciation, and depreciation is normally or it's charged, not normally charged on assets which are non-current assets, and under non-current assets we have what we call fixed assets, right? It's on a certain class of fixed assets. The land and buildings, they don't depreciate, they appreciate in price over time. So there will be no depreciation for land and buildings. In the lessons, or as you learn accounting further, I find that with land and buildings there's what we call revaluation, right? That is not part of your syllabus, right? Keep syllabus at high school. That is when you go to varsity, right? So we're going to look at depreciation, for different um, fixed or tangible assets, right? And this particular fixed tangible assets, not number 3 in the financial statements, right? It's not number 3, fixed or tangible asset, right? So depreciation is the decline, right? So we call it the decline in value. So in asset depreciates in value is being used, which is referred to wear and tear. Right, I can give an example. If you buy a car, if you go to a dealer, the car is new, it's only have mileage for testing, right? Then you buy the car, let's say maybe it's a Polo. You buy a Polo for 360,000, brand new, right? You drive it off to your house. Then when you go to your house, you decide, let's say you bought it for cash, and then tomorrow morning decide like, no, I don't want that Polo again. You come back to the dealer, right? You bought it for 60,000, but the dealer will not buy it from you for 360,000, the amount that you paid yesterday, right? Because it's already lost value. So this is what we call wear and tear. When you're using something, it depreciates in value, right? Or in other words, gets older. The older it gets, right, the lower market value it is. It is allocated as an expense. So this is an expense account in the financial statements, right? It will be for each financial year. So each financial year calculate depreciation, each financial period, then that is expensed as operating expenses. Right, accumulated depreciation, total depreciation over the years. Right, if you hold an asset for 3 years, depreciation will be charged for those 3 years. Then depreciation for the 3 years will be called accumulated depreciation. So every year you charge depreciation, and you add to an account called accumulated depreciation. That is account that is all the depreciation for that particular asset or fixed asset over the years. That's accumulated depreciation. Then carrying value or book value, right? This is the amount that the asset is worth, right, in the books. That is mostly we're talking about the balance sheet, right? This is what we show is shown on the balance sheet in the face of the balance sheet. When you're preparing the balance sheet at the end of the year, all your fixed assets are shown at carrying value or book value, right? How do you get carrying value or book value? That's cost price minus accumulated depreciation to date, right? If you're preparing your balance sheet today, so we're saying how much is depreciation up to today, so for you to know the carrying value, right? Then residual value, the amount that is not depreciable, right? With this residual value, your syllabus doesn't cover it in a greater detail. You find that when you're calculating depreciation, when you go to varsity, you use residual value as much as you can, because assets, they don't have a residual value of 1 rand. Most of them they do have, but the residual of 1 rand is used when you fully depreciate your asset, right? And you cannot depreciate your asset to zero. At any given time, you cannot keep an asset at zero value. So let's say maybe you bought a vehicle for 100,000, it's a backing, and your depreciation was at 5%, 20% per annum. Then after 5 years it will have been fully depreciated, right? That's 5%, that's 20,000. 10%, sorry, 20%, right? That's 20,000 every year. Then after 4 years, 5 years, right, it's on zero. That's the carrying value. But you cannot have that vehicle being shown at zero. So what you do is your last, remember you charge depreciation for year 1, to 5. At 20, that will be 20,000 each. Right. So if you multiply that by 5, this will give you 100,000. That means your carrying value will be 0, but you cannot show that particular asset at 0 value. So what you do is you adjust your last depreciation. Instead of it to be 20,000, you say minus 1, so that will be 19,999, right? So that the asset can be shown at what? At 1 rand value, right? So that's a fully depreciated asset. But as you go, you find that most of the times they will tell you that you bought a vehicle for 20,000, 400,000. Its residual value is 5,000. So that means this amount is not depreciable. So when you're calculating depreciation, you're going to say 100,000 minus 5,000 times the rate of percentage is 20%. So depreciation becomes different. That means you're calculating depreciation on what? On 95,000 only, not 25,000. That is the residual value. So depreciation will be calculated at 95,000. Just an illustration in terms of the residual value. Then depreciable amount, total cost less residual value. That's the 95,000. The total cost less the residual value. That's the depreciable amount. Then methods of depreciation. Right, I've got 2 methods of depreciation. Right, the first one being fixed installment method, which is what we call right. We got fixed installment method. Right, this is what we call fixed cost method as well. It can be referred to fixed cost method. It can be referred to as fixed installment method. Or it can be referred as a straight line method, which is the most common term used, straight line method. But when they say fixed installment, fixed cost, fixed amount method, it's the same. It basically means the depreciation is the same for every year. It doesn't change, right? If you charge depreciation for that particular asset, let's say it was 10,000 depreciation for year 1, considering it was a full year. Remember, a full financial year is 12 months. Right, so if year 1 you charge depreciation for 10,000, that means all the other years the depreciation will be 10,000. That's the fixed installment or fixed cost of straight line. It does not change. Right, then is the cost price method as well. Right, it can be referred as cost price method. Right, takes account of the useful life of an asset. Right, when we say it takes account of the useful life of an asset, this is what we mean. Let's say I bought my asset for 200,000. Right, the asset was 200,000. Right, and so that's the cost. Then useful life. Is 10 years. So basically, when I'm calculating constant depreciation, so my asset,
right? It's worth 200,000 and it's got an estimated useful life of 10 years. So my depreciation will basically be 200,000 divided by the 10 years, because after 10 years that particular asset will be fully depreciated, which gives me 20,000, right? 20,000. So we can deduce the rate of depreciation from there, right? So we're going to say 20,000 over 200,000 times 100 over 1, right? That will give you 10%, right? That will be 10%. That will be the percentage of not the percentage, that will be the rate of depreciation, right? If you want to calculate the normal way that I was taught at school, that will be 0 0 0 0 0 0 2 1 2 1, then I'm remaining with 10, then 10 to 10 1, 10 into 100 10. So that will give you 10%, right? Just mere calculation in case you run out of a calculator, right? Okay, all right, so that will be 10%. So that will be how you deduce depreciation when you're using a fixed installment method or straight line method. We can calculate the rate of depreciation using the number of years or the expected useful life, right, of an asset. Right, okay, so let's look at work number 1. The financial year of Tony ends on 28 February. It ends on 28 February. That means the year should have begun on 1 March 2018 if it ends on 28 February. On this first day of the financial period, they bought a vehicle for 200,000, right? So on the first day, right, they bought a vehicle. That was 1 March 2018. They bought a vehicle for 200,000, and the depreciation policy on vehicles 20% on cost. Calculate depreciation for 2019, 2020, and 2021. Okay, so let's try and calculate. So for day 1 it was bought, right? It had a carrying value of 200,000 and a cost price of 200,000. So it's the same. But when you go to 28 February, 19, right? My calculation for depreciation will be 200,000 times 20%. That will give you a depreciation of 40,000, right? Since you must first time depreciating the asset, right? Accumulated depreciation will be 40,000 as well, right? That will be the accumulated depreciation. Then carrying value will be now the cost price, which is 200,000 minus the accumulated depreciation. So for carrying value here, I will say 200,000 minus 40,000, right? That's my accumulated depreciation, which is 40,000. So the price here will be 160,000. That will be my carrying value. Then at 28 February 2020, right, my depreciation will be calculated the same way.
straight line method times 20%, which is 40,000. So my depreciation will remain the same, but now my accumulated depreciation, right, I'll add this plus this, right? Or you can say accumulated depreciation plus current year depreciation. So this will give me 80,000, right? Then for my accumulated carrying value, it will be 200,000 minus 80,000, which is 120. Right, then I go to 2021. Right, calculation will be the same. That will be 200,000 times 20%, which is 40,000. Then my accumulated depreciation again, it will be all the depreciation area together, which is 120. Right, then here I'll say 200,000 minus 120,000. I'll get 80,000. Right, so that's how you calculate depreciation. Right, what you need to be mindful of is, when you are calculating depreciation, is the depreciation for the asset remains the same all the years. Then you increase accumulated depreciation by the depreciation that you calculated each year. So first year was 40,000, the same as because was the first time depreciation, but second year I increased it by the previous depreciation, by the current depreciation, then go on like that. Right, so that's why I mentioned the RAS spot exactly on the first day of the financial year. I then working to the financial year of 20 ends on 28 February 2019. On 1 July 2018, bought a vehicle for 200,000. Depreciation policy on vehicle is 20% on cost. Calculate depreciation for 2019, 2020, and 2021. Right, so more like the same. Right, for 2019. Depreciation will be calculated as 200,000 times 20% times, remember I bought the vehicle on 1 July. That means it wasn't used for the full financial year the first time that you bought it. Right, so we calculate from 1 July to 28 February. That will give you 8 months, if I'm not mistaken, at 1 July to 28 February. Right, so that's July, August, September, October, November, December, January, February. 8 months. This will be times 8 over 12. That's the fraction of the year that the machine was being used, or the vehicle was being used. Right, that will give you 40,000 times 8 divided by 12. Times that will be 26,667. I rounded it off.
I then accumulated depreciation of 26,667. Right, then that will be 200,000 minus 26,667. This will give you 173,333. That was for first year. Then when we go to 2020, it will be 200,000 times 20%, because now full year depreciation, that will be 40,000. Right, then accumulated depreciation will be 66,667. Right, then accumulated depreciation, so the carrying value, right, will be 133,333. Right, what I just wanted to show you was the difference between this and this. The reason being is because on the first year that we bought the vehicle, we didn't use it for a full year, for a full financial year. We use it for only a fraction of the year, so we only charge depreciation for the time that we're using the asset, not the full year when we only use it for 2 months. So if you buy the asset during the financial year, you only charge the depreciation from the time you owned the asset. Right, you don't charge a full year depreciation. Right, then 2021 it will be the same. Right, then the next one is the reducing balance method. Right, that is the reducing balance method or diminishing balance method, which is called carrying value, reducing balance, declining balance, or book value. Depreciation calculated on what the asset is worth in the books of the business. So you calculate depreciation on net book value. Right, it's quite something that you need to know, that you calculate depreciation on net book value or carrying value. Right, looking at an example. The financial year of 20 ends on 28 February. We're using exactly the same scenario. Right, on the first day of the financial period, they bought a vehicle for 200,000, and so the vehicle was bought on 200,000 on the first day of the year. And the depreciation policy on vehicles 20%. Right now, they're saying carrying value. Right, calculate depreciation for 2019, 2020, and 2021. You would be glad to know that for the first year depreciation, you calculate is the same as calculate straight line. So first year depreciation will be 2802 and 19. It will be 200,000 times 20%, which we have 14,000. Then accumulated depreciation will be 40,000. Then our carrying value will be 160,000. Then on 28/02/2020, our accumulated depreciation now will be calculating depreciation will be 160 times 20%. Right, I'll explain that. It's simpler that way. Right, that will be 32,000. So what you do is you calculate depreciation what? So 160. Right, so you calculate depreciation on what carrying value, right? Or if you want to write it in a longer way, if you have this table, you don't need to write the longer form. You just take the carrying value, right, from the previous year, then you calculate depreciation. But if you don't have access to this table, the probable thing to do, it will be this is what you're gonna do. You're going to say 200,000 minus accumulated depreciation, which is 40, all in brackets, then multiplied by what? By 20%. So you will say cost price. So this is my cost, and this is my accumulated depreciation. So you say cost price minus accumulated depreciation. Then the result of that you multiply by 20 by the rate of depreciation, which is 20% in this particular scenario. Right. So once you're done, so our cost here, our accumulated depreciation will be 72,000. Right. Then now when you get to this, you can have different ways of calculating your carrying value, right? Even the previous question, you can say carrying value minus depreciation, you still get your carrying value, right? Current carrying value, that is if you are given the previous one. So on this one, that will be 200,000 minus 72, right? That will give you as 200,000 minus 72,000, that's 128. Then I go to 28 February 2020, 2021. Right, my depreciation will be 128,000 times 20%, which is 25,400, 25,600. 25,600. Then my accumulated depreciation will be that's 600, 97,600. Then carrying value, that will be 200,000 minus 97,600, which is 102,400. So with this one, you can see the depreciation is different every year. So my depreciation is different every single year, right? It's not the same, right? It's not like a fixed amount. You calculate depreciation, you remember, using the carrying value, which will give you different depreciation all the time. Right, the shortcut on calculating depreciation, if you don't want to waste time writing all these things, right, you see when you calculate the first 4 year depreciation using diminishing balance or reducing balance, what you need to do is to do this. So my first year depreciation is 40,000, right? And the rate, right, is 20%. So when I go to the second year, right, mathematically, right, I just need 80% of the 40,000, because I'm not going to be
needing the other 20% because it has been removed. So I will say 80% of for 2020, right? I'll say 40,000 times 80%. Times 80%, this will give me 32,000. Then when I go to the next year, right, I'll say 32,000 times 80%. If you're depreciating 10%, of course, we multiply by 10%. So this will give me 25,600. Right, that'll be sorted. So you can have that way as a shortcut instead of calculating right in the whole formula. Only apply this when it's applicable on that particular scenario. Don't just apply it because I said so. Right, it only works when you're using diminishing balance method. That means the previous amount was basically full year depreciation. Then you can calculate 80% of the previous amount. You get your current amount. Right, so in the next question, I think in the next one, if you watch this one first, that means in the next one I'll be looking at disposal. How do you do disposal?